Alright folks, welcome back to Boss Economic World. Grab your coffee, or something stronger if it's that kind of day, because today we're talking about the biggest party of the last 70 years and how the host suddenly decided to get weird, lock the front door, and charge everyone else a fortune to stay. The party, of course, is global trade. And the host? Well, you get the picture. For years, everyone played by a certain set of rules, more or less. But then, President Trump came in with his tariff bazooka in the late 2010s, aiming to bring everything back home. The experts all predicted the same thing: a global recession, a trade collapse, economic Armageddon. They told us the Jenga tower of global commerce would come crashing down. Well, it's October 15, 2025. I've looked out my window, and the sky has not, in fact, fallen. The Jenga tower didn't collapse. Instead, the other players just, very carefully, pulled out Uncle Sam's blocks and started building their own, separate towers. Today, we're unpacking the great economic rerouting. This isn't just a story about tariffs, it's a story about resilience, adaptation, and the redrawing of the entire economic map in real time. Forget what you thought you knew. The world of commerce has changed, and we've got the receipts, the data, and the absurd stories to prove it. Let's get into it. First, let's look at what's happening right in America's backyard. It's like a neighborhood barbecue where everyone suddenly stops talking to the guy in the biggest house. Take the auto industry. For decades, the flow was simple: parts and cars flowed between the US and Canada like a well-oiled machine. It was the backbone of the North American auto corridor. But today? Canada is importing more cars from Mexico than from the United States for the first time in modern history. Why? It's simple math. Years of tariff threats, supply chain uncertainty, and the nearshoring boom have made Mexico an incredibly attractive, stable, and cost-effective manufacturing hub. Companies like Stellantis, GM, and Ford have been quietly beefing up their Mexican operations for years, and now we're seeing the result. It's not that Canada and the US aren't trading, it's that the path of least resistance and greatest profit no longer automatically runs through Detroit. The US tried to build a wall, and in an economic sense, other countries just built a bypass around it. And it's not just cars. It's food. Let's talk soybeans. For an American soybean farmer in Iowa, the calendar used to be simple: plant in the spring, grow in the summer, and in the fall, sell a massive chunk of your harvest to China. It was a golden ticket. But now, at the peak of harvest time, those farmers are watching the ship sail right on by. China, in a masterclass of de-risking, has systematically shifted its agricultural lifeline to South America. Brazil and Argentina are having a field day, literally. They've invested heavily in logistics, ports, and crop technology, funded in part by Chinese investment, to become the primary suppliers to the world's biggest food importer. This year, Chinese purchases of US soybeans are down a staggering 40% year over year, while imports from Brazil are set to hit a record high of over 110 million metric tons. China effectively told the world, we will not let our food security be used as a political bargaining chip. They spent a decade diversifying, and now, the American farmer is feeling the full force of that strategic pivot. And for the geopolitical bombshell of the year? India and China. These two giants have been locked in a tense, frozen standoff for years over border disputes. But money, as they say, talks. Or in this case, it flies. Direct flights have resumed. More importantly, they're trading in strategic materials. India, seeking to build its high-tech manufacturing sector, needs rare earths. China, the world's dominant supplier, needs new, reliable, massive markets. They're finding common ground in commerce, proving that economic necessity can thaw even the iciest of geopolitical freezes. This isn't just a few isolated incidents. This is a pattern. A fundamental rewiring of the global economic motherboard. So, what happens when the world's largest consumer decides to make its market harder to access? You'd think it would be a catastrophe. But the reality is, 85% of global trade doesn't even involve the United States. That 85% didn't just sit around and cry. They got busy. They formed new clubs. They dusted off old agreements. They created what I like to call the coalition of the pragmatic. We're seeing the rise of powerful new economic blocs. A group of 14 countries, including savvy traders like New Zealand, Singapore, Switzerland, and the UAE, have formed a partnership specifically designed to lower trade barriers and boost investment amongst themselves. They're creating their own frictionless ecosystem, a sort of business-class lounge for global trade, while the US is stuck in the middle seat it assigned itself. And then there's the European Union. Oh, the EU. For years, they were caricatured as a slow, bureaucratic behemoth. But a little bit of external pressure can work wonders. As European Commission President Ursula von der Leyen said, they are laser-focused on expanding their web of 76 trade partnerships. They finally pushed the Mercosur deal over the finish line. This is the trade agreement with South American countries like Brazil and Argentina. It was in negotiations for 25 years. A quarter of a century. What finally got it done? The sudden, urgent realization that in a world where the US is an unreliable partner, creating a market of 780 million consumers is a damn good survival strategy. And they didn't stop there. An EU-Indonesia pact, a decade in the making? Done. An EU-Australia deal that was stuck in neutral for 6 years? Suddenly it's in overdrive. As Simon Evenett at IMD Business School puts it, there's been a shot in the arm for ongoing trade negotiations. It's like the world's trade negotiators all drank a triple shot espresso at the same time. Smaller economies are getting scrappy, too. Peru, famous for its blueberries, used to ship a huge portion of its harvest to the US. Now, facing tariffs and competition, they're aggressively marketing to Asia, where a rising middle class has a newfound taste for superfoods. Lesotho, a tiny African nation known for its textile industry, is no longer banking on the US market. They're pivoting to the rest of Africa, Europe, and Asia, diversifying their customer base so they're never again beholden to the political whims of one country. This isn't a retreat from globalization. This is Globalization 2.0. A multipolar, decentralized, and far more complex version of it. Now, I know what the skeptics are thinking. Boss, this is all just talk and a few anecdotes. Fair enough. So let's look at the cold, hard numbers. Because the data is telling a story that is impossible to ignore. Remember those dire predictions of a global trade collapse? Well, the World Trade Organization just dropped its latest forecast. They now expect merchandise trade to grow by 2.4% in 2025. That's a massive upward revision from the paltry 0.9% they predicted earlier. Why the jump? A big part of it was what economists call front-loading, companies rushing to ship goods before new tariffs hit. It's the economic equivalent of hoarding toilet paper in a pandemic. Now, the IMF's New World Economic Outlook, released just today, does offer a dose of reality. They note that while this panic buying propped up trade volumes, they expect growth to cool to an average of 2.9% over the next couple of years, down from their previous forecasts. So, things aren't perfect. The friction is real. But a slowdown is a universe away from the collapse we were promised. It's more like the global economy is shifting from a V8 engine to a still powerful but more efficient hybrid. But here's where it gets really interesting. Let's look at China, the primary target of the US trade war. In August, their exports to the US plummeted by a shocking 33%. If you only read that headline, you'd think the Chinese economy was on the ropes. But you have to read the whole report. In that same month, China's exports to the 10-nation ASEAN bloc in Southeast Asia soared by nearly 23%. Exports to the EU? Up 10%. To Africa? Up a massive 26%. What this tells us is that China is successfully executing the world's largest and fastest commercial pivot. They are still on track to post a record $1.2 trillion trade surplus this year. They haven't stopped exporting, they've just changed the mailing address. We can even see this physically, on the high seas. Look at the shipping data from Clarkson's, a major maritime industry analyst. The Trans-Pacific Corridor, the main highway for ships between China and the US, is projected to see a nearly 3% contraction in shipping volumes this year. It's the only major shipping lane in the world that is shrinking. Every other lane is growing. As Ina Simonovska at UC Davis says, it's very clear that we are redrawing the map of international trade. We're not erasing the lines, we're drawing new, thicker, and more numerous lines that completely bypass the United States. Christian Gonzalez, an executive at a major port operator in the Philippines, sees it from his front row seat. He says Chinese manufacturers are relentlessly prospecting for new markets, and for his business, which sits at the crossroads of these new trade routes, this remapping is very positive. His company's stock is up almost 30% this year. The message is clear, global trade will continue flowing. It just might not be flowing through the port of Long Beach anymore. Now, it's not all sunshine and roses in this new world order. There's a dark side to this scramble. The old system, for all its flaws, was governed by the WTO. It was a rules-based system that, in theory, gave a small country the same voice as a big one. It provided a framework for resolving disputes that didn't just rely on raw economic power. But in a world of bilateral deals and massive trading blocs, the small guys are at risk of getting squeezed out. Ishwar Prasad at Cornell University warned about this, saying the shift from a common set of rules to an every-country-for-itself model will be a much harsher world for countries that lack the economic heft of the US. Consider the tiny nation of Timor-Leste. You may have to look it up on a map. With just 1.4 million people and a GDP per capita of around $1,300, it's one of the smallest and poorest economies in Asia. It just became the WTO's newest member, a process that took them over a decade. Their representative, Antonio de Conceição, is hopeful. He dreams that WTO membership will help his country diversify away from oil by finding new markets for its coffee, vanilla, and fruit. We are a country that can start to learn from others, he said, full of optimism. But you have to wonder, in this new era of economic power politics, will anyone listen? Will Timor-Leste find its footing, or will it be trampled in the stampede as the EU, China, and other giants carve up the world into spheres of economic influence? The breakdown of the old system might empower regional players, but it risks leaving the most vulnerable nations behind. To really understand how bizarre this new landscape is, let's zoom in from the 30,000-foot view of global trade to one small business in Pennsylvania. Meet Ben Knepler. He runs a company called True Places. He designed a fantastic, high-quality outdoor chair, the kind you'd be proud to take to a picnic or the beach. The design is American, born in Wallingford, Pennsylvania. But to get the quality and cost right, the chairs are manufactured in Cambodia. For years, his business model worked. Design in the US, manufacture in Asia, sell to Americans who love the outdoors. But then, the tariffs hit. Suddenly, importing his own product into his own country became so expensive that his business model was no longer viable. So what's he doing? He stopped importing his chairs into the US entirely. Instead, he's now desperately scouting for customers in Europe and Asia, trying to keep his American company afloat by selling his product to literally anyone but Americans. Let that sink in. He said, "It's a bit of an absurd situation that we're even considering this. But here we are thinking about being a US company and not operating in the US. This is the tariff paradox in a nutshell. A policy designed to protect American business has forced an American entrepreneur to abandon the American market just to survive." Ben Knepler's story isn't about billions of dollars or geopolitical strategy. It's the human cost of this great economic rerouting, a story of unintended consequences and profound absurdity. So, let's bring it all home. What's the big picture here? For nearly a decade, the narrative was that America's protectionist turn would shatter the global economy. But that narrative was wrong. The global economy didn't shatter. It adapted. It evolved. It proved that it is a dynamic, resilient network, not a rigid, centralized hierarchy. The world has learned a crucial lesson: relying too heavily on any single market or any single supplier is a critical vulnerability. Diversification is no longer just a good business strategy, it's a national security imperative. The result is a new world that is messier, more complex, and more regionalized. We're seeing the emergence of three major economic spheres: a North American bloc, a European bloc, and an Asian bloc dominated by China and increasingly integrated with its neighbors. The US isn't irrelevant, not by a long shot. But it is no longer the undisputed, essential sun around which all other economies orbit. It's becoming just one of several large planets, and it's a planet that is increasingly isolated. The old map of global commerce, with the US at its center, is being torn up. The ink is still wet on the new one. The question for the next decade is not if the world can get by without America at the helm, because it's already proving that it can. The real question is, where will America find its place on this new map that it inadvertently helped create? Thanks for watching Boss Economic World. Think about it.